So what we want to look at is something that might be a bullish opportunity. Okay, so here we're going to look at Schlumberger, roughly at 83 3/4, and our dollar weighted put call average in this name is roughly 0.19. So obviously at a value less than 1, which is very bullish on the dollar weighted put call average. It's got a unit vol of 36, and the implied vols are substantially lower than that. So there's not a lot of activity. So it seems with the vols being down, chances are saying the vols, when they're historically lower than they should be, chances are that stock has been making a gradual move up, or is about to make a move up, as vols seem to collapse on the upside, as we all know. So when we look at this spread, what do we want to look at here? Well, once again, we want to participate in the 2 different months. In this particular case, we're going to be selling the August 85 call, and we're going to be buying the July 82.5 call. So in this particular case, what are we doing? We're buying a lower strike call, which is 82.5, and we're selling a higher strike call, which is an 85. Now, obviously, in this position, we're buying the one that has less time, and we're selling the one that has more time. So what we're looking for here is a little quicker move. We don't want a long time frame to pass, because obviously we don't have that much time with our long position. We only have 37 days. And that short position, there's 72 days remaining. So when you look at your different datas in Vegas, you can see here that we're creating a positive delta position. Okay, here's the positive delta dollar-wise, but you look at the delta position here, you can see that the delta position is a 48 for the short and a 58 for the long. So we're approximately long 10 deltas for each one lot. Or if you look at it 10 times the, we're looking at almost, maybe, what kind of deltas are they showing here? Almost $100 worth of deltas. You look at what we're doing as far as your position for your Vega. In this particular case, we're paying. And we're collecting. We're collecting 44.14, it looks like. We're buying that. We're selling that. So our short is collecting. Let me widen this out a little bit. Okay. So we're selling and collecting 148, and we're buying and paying 104. So we've got a little profit coming in because we're selling a premium option in the 85 that has substantially more premium than obviously that we're looking at in the 82.5 call that we're long. And that's easy to examine by just adding the premium or the value of the call in the July to the strike, and you'll see we're talking about roughly 86 1/4. Okay, whereas if you were at the 85 call here, the premium there, you're talking 88, 85. So there's a difference there that you can see, and that's what we're trying to capture. So what does that look like when we talk about, let's see the position chart on this. Well, it's exactly what we're talking about again. We're looking at the part that we lose the most, and what is that? Well, we're now long the front month, which is July, and we're long the July 82.5 call. So that is going to be our exposure as far as our risk is concerned. At 82.5 at July expiration, which is this line chart that you're looking at. Okay, and the blue line is a real time, so you can see it's a slightly bullish over a period of time as far as our P&L capability. But when you look at it at expiration, what we're trying to do obviously is we want the stock to move upward and move as far away from that July strike that we own at 82.5, and you can see it continues to gain momentum on the upside. And even though we're short the 85 call in July, what are we picking up? We're at least picking up the difference of those 2 strikes, which is 2.5 points. And what you're seeing here is what you would see very much like a buy right when you're long stock and short a call in a far out month. The only benefit here is that you're not taking a downside risk position to being long stock, right? Your position basically is long a call that once it loses its value right here, you can lose no more. So beyond that, you could see that if the stock were to close lower than the 82.5 strike that we're long at expiry in July, it seems that we're not losing as much, because what's happening? The call that we sold in August is now losing its value. So the inverse of what we just showed in our position that was a bearish position beyond the expiration of the front month, here we're getting some of that money back because, once again, the call that we're short has some meat to it, so it's starting to evaporate. So when you look at these opportunities, you can see there are ways to get long and short, to try and find opportunities to make a small amount of money and not risk a great deal, but you're creating what I like to call is, with pinpoint accuracy, different areas on where you think a stock may be going to.